Hello, and welcome to another episode of ZEP Learning with myself, Zane, the owner and director of ZEP Finance. I'm here today to talk to you about how is your borrowing capacity worked out. I get a lot of questions from clients about this, and just note your borrowing capacity has absolutely nothing to do with how much money you have in savings or how much equity you have in your house. It is solely based on your income and your expenses. So here's the basic calculation. First of all, the lender will start with your gross income. From there, they'll tax that to be left with the amount of money or your net income, which is the money you get to spend and take home in your bank. From here, they'll take away your general living expenses. Now, I get a lot of people saying they spend a lot less than what the bank's using for their calculation. Unfortunately, we can only nominate to spend more money on our living expenses than the bank has offered, or we use their minimum expense. This cannot change and will not change, and in fact in the last 6 to 12 months this amount has gone up quite a lot. Once they've taken away your general living expenses, they'll then take away any ongoing debt expenses that you have. So for personal loans and credit cards, personal loan they'll use the exact repayment with most lenders. For credit cards, they'll use 3% of the credit limit. It does not matter whether you have $1 owing or the card fully maxed out, they're treated exactly the same. Please note, interest-free cards that you get from Harvey Norman and those places are still classed as a credit card and they have a limit. Once they've taken away those expenses, they'll take away any ongoing mortgages, and they'll look at your remaining principal and interest term, and then they'll add a buffer onto that loan. Some lenders are affording those debts at maybe 7% as the interest rate. Just then they've built in a buffer in case things were to change in the market. After that, they'll take away any ongoing expenses that you may have. So that could be if you're buying investment property, it might be your rent, could be child support, could be a HECS debt, anything like that that you've still got to pay, they'll take that away. And then what's left at the end is called your net disposable income. So that's the amount of money you have after all your expenses taken away that you have to make the loan repayments with. Now when you look at this figure, it's often quite a lot more than what the loan repayment would be on your loan. Lenders are making sure that they've built in a buffer in case interest rates were to increase. So most of the time, lenders are making you afford that loan at between a 7% and an 8% interest rate, which is called the assessment rate that lenders will use. This is how they figure out how much you are able to borrow. If you would like to find that out for yourself, I'd love for you to give me a call and we can work that out. Thank you for watching today, and as always, we have a great wealth of information on our website. We have the Learn tab, which has downloadable fact sheets, blogs, and also calculators. And then we have the Videos tab, which has approximately another 20 to 30 of these videos for you to watch and get everything you need to know. Thank you for watching today, and I look forward to hearing from you shortly.